Michael Burry, the investor who is famous for predicting the 2008 real estate crash, recently released what his new portfolio looks like in his 13F. And as you can see, he sold every single stock that he owned besides for Estée Lauder. So in this video, I'm going to do a quick Estée Lauder stock analysis. So taking a quick look at Estée Lauder, you can see that they currently have a $24 billion market cap, but the stock is down 67% over the past 5 years. Looking at their financials, you can see pretty easily why they're down so much, and that's because their revenue and their income has been going down massively. They had their highest revenue in 2022, and since then it's dropped from 17.7 billion down to 15.6 billion. At the same time, you can see their total net income was negative 871 million in the last 12 months, which is also down again from in 2021, $2.8 billion in profit. One, they have a pretty strong balance sheet with a total of $7 billion in current assets and $19.8 billion in total assets compared to $15 billion in total liabilities and $5 billion in total current liabilities. So they have enough to pay off all their debt currently, and they should be okay, assuming they're able to continue generating cash. But now looking at their cash flow statement, you can see it's actually not as bad as what the income statement makes it look like, mainly because they had an asset write-down of $1.3 billion in the last 12 months, which made the net income look worse. So for their cash from operations, they actually did, taking out changes in net working capital, they did 1.1 billion, which is pretty good. But, they still have massive capital expenditures, 600 million, and they have a huge amount of stock-based compensation. So that basically negates all the cash they earn from operations. They've also been repaying their debt, but they've been paying so much in dividends that they end up with a big negative in change in cash. So in the past 12 months, they're down $1 billion in cash. But I don't think the current financials is why Michael Burry is interested. I think it's a lot more likely because of their new plan. They recently got a new CEO, and what he announced is they're making a new thing called Beauty Reimagined, or they're not making it, it's a new plan. And the plan is basically to just cut costs. They're going to decrease all the costs and increase advertising and marketing, try to increase their sales, stop the negative growth. And they announced that they'll cut up to 7,000 jobs, and the goal is to create savings of between 800 million and $1 billion. This is obviously massive, and if they can do that, that would be huge for the company, and they would be making a lot more, and they'd be a lot more profitable. Now, my concern is, while cutting costs is great and all, they have been getting crushed in their sales. Looking at their most recent earnings, you can see skincare sales decreased by 11%, makeup decreased by 7%, fragrances barely decreased, but it still decreased, it didn't increase, and hair care decreased by 10%. So their sales are going down massively. Spending more on advertising and marketing could help, but that's also once again going to raise costs. And so I would assume this is why Michael Burry is interested, just because if they really can save 800 million in savings, then they will be trading, let's just say, if they can save 800 million, that could make them profitable. And, assuming that the last 12 months were, just way worse than normal, and assuming they go back, let's say in 2024 they did 400 million, they would be making 1.2 billion, which would mean they would be trading at, I don't know, like 30 times earnings, which isn't nearly as bad as, obviously negative earnings. So that's why I think he's interested in it. But my concern is, but to me, I don't think it's as interesting, especially when they have competitors like Elf, for example, which don't just not have negative revenue growth, but they've had massive positive revenue growth, like 12%, 23%, 47, 76, 28, and that adds up quickly. And obviously, Elf is a much smaller competitor, but why would I want to look at a company that has such decreasing earnings and revenue? And yeah, obviously Elf is more expensive, but why wouldn't it be more expensive? They're growing at a great pace. So yeah, that's my super short analysis of Estée Lauder. If you want me to look more into it, let me know. Or if there's anything you think I missed, make sure to let me know. But yeah, overall, I think it's an interesting idea. But the sales decrease is very scary to me, and I don't know how easy it'll be to get their sales back up.